Welcome to Market Blaster, where we blow apart the stock market and put it back together so that it makes sense for you. I'm Forbes Markets editor John Dobis. Shares of Apple absolutely sliced nearly 5% on Wednesday after reporting a quarterly disappointment in sales and profits for just the second time since 2003. The company had some pretty respectable numbers if you didn't know it was Apple. Net income up 21%, revenue up 23%. Analysts were looking for $10.37 a share in EPS. The company only came up with $9.32, blaming it, a lot of it, well, on Europe, of course, but the fact that people who have the iPhone 4 or 4S or earlier models can't upgrade to anything. And they've been maybe putting that off until the iPhone 5 comes out, which now looks like it will be in December. That's 2 quarters away from the one that was just reported. So, a bit of disappointment in Apple shares. This guy here, the new cook in the kitchen, Tim Cook, the CEO who took over after former CEO Steve Jobs passed away last October, he doesn't have a great streak under his belt right now. He's a great caretaker, but can the guy grow the company? We will see about that. Here you see Apple shares feeling gravity's pull, going down just to the 50-day moving average, $575. Here's the 200-day. So Apple had been perched at a mighty loft and has come down now to a point where if the stock does maintain its uptrend, this will be a great buying point, folks, here at the 50-day average. But we don't really know. The iPhone 5 will probably be the next catalyst to drive sales and profits higher, and that doesn't come for a few months. Very nice report out on Wednesday was from Caterpillar. Caterpillar delighted analysts with a beat on the top and the bottom line. Earnings up 67%, a 22% boost in sales for the quarter. This, of course, does include the acquisition of the Bucyrus division. It's a mining company. It used to be based out of Wisconsin, and Caterpillar took it over. That was responsible for about 1/3 of the growth in sales. The rest was from volume growth. So Caterpillar doing okay. Kind of a weird, finicky day for the stock. Cat, it was up above $85 at one point, below $80 later in the day, and then it had recovered to about $82.50 by the time trading had closed. So Caterpillar beating the street and rising. You can see the stock has tumbled to about $80 from where it was, 115 just about 5 months ago. Caterpillar doing nicely. Oh boy, nice days there for Reed Hastings, the CEO of Netflix, holding up the DVDs. Those were the days when the company was just growing like a weed. Well, it's not anymore. Profits were down 90%. That's correct, folks. Profits down 90% to $6 million from $61 million for the quarter. And worse yet, the company had been saying that they're going to add 7 million new subscribers in the U.S. by the end of the year. Nowhere near on track to achieve that. So, look at the shares, down 25% in one day. Netflix, you'll recall, was everybody's hero last year, topping out at $305 per share in July of last year. Now we're looking at a $60 stock, just 1/5 of what it was last year. And of course, it's rallied from $60, but now back to $60. Netflix, just looking awful. Hey, not looking so bad there. She's quite happy. Look, she's got her 2-liter beverage and some wrapping paper, and she's going to get herself a DVD from the Redbox. Redbox, of course, operated by Coinstar. DVDs are about $1. Yeah, there you go, $1 DVD rentals. Cheaper than Netflix. Here's the company that makes it, Coinstar, which reports earnings on Thursday. 12.7 times trailing PE. Sales are expected this year, if all goes well on Thursday's report, to grow 23.7%. When you're paying a PE of 12.7 for something that's growing at about twice that rate, back home we call it a bargain. So Coinstar coming down from $70 to $59 in tandem with the market's pullback. A little bit steeper, of course, but Coinstar coming out with earnings on Thursday. Let's talk about shacks, some famous shacks. Of course, you got the Love Shack from the B-52's 1989 album Cosmic Thing. Love, Shack, Shimmy, Baby, Tin Roof, Rusted, all those lyrics. Shake Shack over here on 23rd Street and 5th Avenue at Madison Square Park. It's always crowded, always a line around the park. Even if you go out to a Mets game at Citi Field, you're talking about big lines at the Shake Shack there. This is a RadioShack store, and you'll have no trouble with big lines at a RadioShack store. Unfortunately for the company, took a big Netflix-sized hit today after reporting a surprise loss of $21 million. Analysts had expected a gain of about 3 cents per share, 21 cent per share loss for the quarter. Here's the old TRS Trash 80. Ran on a cassette tape drive, kids. Back in the day, yeah, we played Space Invaders and ran BASIC, BASIC, the beginner's all-purpose symbolic instruction code. Hey, how about that? But Trash 80 and, you know, RadioShack just aren't what they used to be. The company did used to pay a dividend of 50 cents per share. Of course, when you're like a $3 stock, that's a heck of a dividend. And anybody who could think could probably see there was trouble coming. Well, their trouble is here. RadioShack discontinued the dividend. Shares down 26% on Wednesday. Just a horrible situation. Really, the stock has done nothing but fall for the past decade. Somebody can do something with the company, but right now, just underperforming everything, looking like on the verge of extinction. So I told you about dividends and how they can be discontinued and what happens when they are. Look at RadioShack. We started a new thing here at Forbes called the Forbes Dividend Stock Daily, and I agonized daily over picking a stock for this thing. Today it was Waste Management. Do you know what the stock yields? About 4.3%. It's got a lot of debt. Everybody in the trash business does, but WM is looking pretty good. You know, you want to see earnings that are growing. You want to see good coverage of the dividend, obviously, and you just want to see reasonable valuations. Here are some stocks that have been in the letter in the last week. Nucor is looking good with almost a 4% yield. Cablevision, very fat yield. Smaller company, just really operates here in the Northeast. France Telecom, you're talking about almost a 13% yield there. Stock is doing just fine. Pitney Bowes, the stamping equipment, you think it's a dying business? Well, it is decreasing, but they're trying to get into new businesses, yielding now about 12%, 11.5% at Pitney Bowes. Steelcase and Staples, of course, they're tied to the office market. So we got some neat stuff there. You should go to ForbesNewsletters.com. Check out on the left-hand side, Forbes Daily Dividend Stock. Here we go, Facebook and the Muppets and Zuck. Got an earnings report out on Thursday from Facebook. Of course, the stock went public, 38 bucks a share back in May. Has done really nothing but tumble since then, down to 29.37. We'll see what Facebook has to say, and again, maybe it could possibly get above 30 bucks. So watch out for the Shack. Give Apple a second chance, perhaps, because you'll know you want to own it in December.